Good evening, everybody, or I guess depending where you are, good morning. This is Jeff Scott. I'm sitting out here in Anaheim, or Irvine, California, at the George Lee Greg Mills meeting, where I had the opportunity of presenting today how I look at shorting. And although I wasn't planning on doing my weekend review this week, I decided to go ahead and do it tonight since I pretty much did all the prep work as part of my presentation here. It is 1:41 in the morning Eastern Time, or about 10:45, 10:41 Saturday night out here in California. Email address is hgsidoc@gmail.com for any questions, comments, or concerns. Disclaimer, I'm an unpaid volunteer. I do this for fun. I do this because I've been fairly blessed financially, and I like to teach, so it's just a great opportunity to give back. This is for educational purposes only. Any recommendation in the spirit of education should not be considered investment advice. I'm a doctor, not a broker, and I'm not affiliated with any software vendor or trading company. I have paid for all my tools, and trading involves risks, and you alone are responsible. Please note I do not have my external microphone for this video, so audio may be less than perfect. As always, I like to call out and thank my mentors, whether it's Cancelim on the left, as taught by O'Neill, improved by Morales and Katcher, and added steroids and electronics by Ian Woodward and Ron Brown, blended with the trading strategies, scanning indicators of John Person, author, trader, mentor, and friend of mine, and then with a little bit of Ann Tharp for money management, as well as George Lee. A lot of the things that he does have been a big influence on me as well. I have a large number of programs, but all I really need are a real-time platform. I use all three of them. Frankly, I do most of my work with TradeStation and do most of my trading with Thinkorswim, only because I find that interface easier to use. HGSI is my favorite tool for analytics, and that would be both from the perspective of end of day and then delayed real time, or delayed intraday, not real time. I do seasonal analytics with Magenta, Best Choice, and Seasonality Trader. It was great to meet the new ownership of Best Choice out at this meeting. He's done a nice job presenting. And then I use a large number of websites. This is an old slide from Ian, and I thought it was apropos for this weekend, especially when one considers that we're getting near resistance. And when I grew up in the States, it was chutes and ladders. Apparently in England, it was snakes and ladders, but the point is the same. And the point is that you don't want to make a lot of money, get near the finish, and then hit the snakehead and go back down to the beginning. One of my biggest flaws in my trading early on was I was really good at making money. I wasn't good at not losing money, and I gave back a lot. And one of the things that I've improved over the time is my money management, and I'm still a good stock picker, and now I try to hold on to more of the money and not give it back with pullbacks. I entitled today Approaching Resistance, and I think that's why I put this in here, because I don't necessarily have signals that we're going to sell off on Monday or Tuesday, but as you see, we're getting increasingly overbought. I'm all about top-down investing. Here's an old slide, but the reason why I spend so much time on the market is I can be the world's greatest stock picker, but the market's responsible for 50% or more of the movement, the industry 20 to 30%. So the stock itself is only good for 20 or 30%. So to me, the most important thing is to determine the market direction and let that determine my stance, short or long, find the most bullish moving industry groups if I'm going long, and take the best stocks in the best industry groups. Again, old slides, but as I comment always is you need to know where you are on this curve. Are you early on in a bull market where you go all in, or are you at a time where the market's rolled over and you need to be much more careful? And frankly, where are we today? Maybe we're at both. What do I mean by that? It means that I gave you 3 scenarios last week, last couple of weeks, and we're right now in the midst of scenario 2, which is running up to the 200-day moving average and potentially finding resistance there and pulling back. And that would put me sort of in the red circle that's fairly imminent. But if I break above that 200-day moving average, come back and retest it from above and hold, then I might be in the green circle. So it's still a pretty wide open story. My concern in the short term is that we're probably getting into a more dangerous area. And based upon where I find myself in, or us in, is really going to dictate what trades that I take. So a little bit about last week. Last week was a pretty good week in the market. You can see in green here, the S&P 500 was up 2.67%. You think about 52 weeks, that's over 130%. The market's not going to be up 2.67 every week. So you should have made money if you were long. The problem is when I talked to a lot of people, they weren't long because they got out of the market with this pullback. Growth stocks performed at or below the market. The Market Smith 250 growth was about almost half of what the market was, a little bit over half. The IBD 50 and the HGS 100 a little bit below the market, as would have been the stocks the prior week had I held on to them and not traded them, which isn't the case. What's most important to me is where were the stocks that I chose as potential buys last week, especially the ones that I traded, which were my filtered buys. And you could see my filtered buys were up 9.57%, 14 out of 16 were up. Not a big shocker. It was an easy market to make money last week. And, I guess one of the things just to show you why I like that high close doji pattern so much is I have a screen for looking at new buys and all the weekly HCDs of the week. And this is before I filter out anything. And you could see that that is 137 stocks, of which 85% were up on the week with an average gain of 3.31%. So good week in the market. Good week for me, and I'm sure a good week for you. I come back to this, I've updated, and I ask which is the S&P as of Friday. And I didn't give you enough information to the left from the top, which was 2008. But the point of this is that, like 2008, we are moving up off of a double bottom and starting to approach what might be resistance at the 200-day moving average. And just to remind people that here's that same picture. And you could see in 2008, we did pull into the 200-day moving average, which turned out to be fairly substantial resistance. And then the market had the big drop. So just because we're running up here into resistance does not mean that all is good and it's okay to be uber long. It means that it's a time of potential risk and concern, but wait till you get a signal that the market's rolling over. You can anticipate, but don't act until you have some type of confirmation. Why did I put this here? Oh, this is the current S&P 500. And as you can see, it's moving up against that 200-day moving average here. But boy, was it bullish looking. All my indicators up top are green, including the daily and weekly bongos. We are coming off of multiple mobile breakouts from a squeeze, pocket pivots and a kahuna, OBV above its average. It's a very bullish looking, reversal here, reversion to the mean. But we are getting close to where I think is highly likely we're going to see some resistance. We'll come back to this chart later. On Friday, it was not as strong a day as earlier in the week, but still a very bullish day with positive outcomes on the indices. And one can see that utilities look strong throughout. Materials remain strong. Some of the energy strong. Regional banks were strong. Where's the weakness? Some technology, retail, consumer discretionary, healthcare, and casinos were weak, as were gold miners. Just gives me a sense of what the money was not flowing into. Now I can look at lots of different pictures to tell the story. This is my Thinkorswim, daily charts, E-minis, NASDAQ futures, Dow futures, Russell futures, VIX, and the dollar. And the reason why I have arrowheads here is just pointing out that it's on the S&P, the NASDAQ, and the Dow that we're right below the 200-day moving average. So we're pulling into a descending line of resistance, which could make it difficult for this market to continue its move. The VIX has traded down and had a green candle low on Friday. That could be a reversal signal, but let's see what happens. And the dollar is pulled down to the 200, which is a place that you might expect to bounce. On weeklies, again, a similar type of a pattern. Move forward. And then the other thing to point out, again, even though I believe we're at a riskier place than what we were a week or two ago, we still are in buy signals in the little green triangle from John's indicators on the E-minis, the NASDAQs, the Russell, the NYSE, and the Dow, as well on the daily as well as the weekly. So one would expect to see a little bit of erosion before this market is done going up. Now, some of the supporting things I look at. Employment numbers were strong. They stronger than expected with some revisions. Also an expectation that perhaps we're going to avoid a recession. And even though there's more talk that the Fed's not going to raise rates in March, you can see interest rates had a pretty good bounce on Friday. Interestingly, despite that, utilities were strong, and still the interest rates are quite low, as you could see. White would be the interest rate. Yellow is the S&P, or in this case, the spiders. And then I have a 50-day moving average in blue and a 200-day moving average in red. And this will be consistent on the next bunch of charts. The AD lines, you could see kind of in white that the small stocks in the Russell 2000 really led prices down on the AD line. Compare that to the 1000, the large stocks, which hardly budged. But notice how the AD lines on the 2000 and the 1000 have turned up and moved back towards highs. How about stocks below their 40 and their 200-day moving average? Well, we've had a pretty big bounce off the bottom on those number of stocks trading below their 200-day moving average. We're a long way from what's overbought on this more longer-term signal. Yet over here, you could see that the number of stocks above the 40-day SMA is now above 80%. It's been pretty much a massive increase in getting to a place where we often see a reversal to the downside in the market. The 4-week new high, new low, another thing I like to look at, also has spiked, telling me that over the shorter period of time, this marketplace is getting increasingly more likely to pull back. McClellan, this is the McClellan oscillator in TradeStation. It's above 240. Again, getting to points where, typically it's offset a few days, that a peak in the McClellan often precedes a peak in the S&P, precedes, I showed you this one, precedes the peak. So are we within a few days of a peak in the McClellan oscillator and a time where this market's going to turn over and come back down? Again, white is the McClellan oscillator and yellow is the S&P. So my HGSI indicators, the buckets, which looks at two things in this picture. The one on the left would be from a week ago, the one on the right. If you look at the pie chart, the green represents the number of stocks in the S&P 15 that are above the midline of their Bollinger Bands. And you could see 93% of these stocks are above midline. That's a very powerful and strong bullish market. You'll also notice that if we break up the deciles to 10 deciles between the top and the bottom of the Bollinger Bands, and then some below and some above, you can see that we're starting to accumulate stocks above the upper band of the Bollinger Bands, a time where, again, you might expect to see some reversals. And I've used this over the last several years with extremes, especially extremes to the downside, to find stocks that are either likely to move to reverse to the upside or downside, depending upon the pattern. No Hindenburg in sight. That may make me feel good that we're not about to have a major correction, but to be honest, I don't trust the Hindenburg with the NYSE containing so many interest rate sensitive stocks and bond funds. It kind of makes me wonder if it's still a meaningful signal. I believe it is, and I'd like to believe that we're in good shape and that we're not about to have a collapse. And then the other thing here, the third set of indexes, the same indexes with multiple different indicators, they're all dark green. This is a market that's sort of a stealthy rally going on, frankly, since the second week of February. I know a lot of my friends and people I talk to have missed it because they're out of the market. Canaries in the coal mine. These are a group of high volume market leaders that we look at to get a sense of what the overall market's doing. And they've come back up, and they had a big doji sitting right on the 50-day moving average, a period of indecision. So are they going to fail and come back down, or are they going to break up and maybe even get above the 200-day moving average? You notice their weekly bongo is still red. And if you look at some of the FANG stocks, up here is Google failing at the 50, Amazon failing at the 50, Facebook hasn't failed yet, but it certainly is having a tough time regaining prior highs. And then the leader right now, perhaps if I was looking to buy one, is Netflix, breaking above the 50 with a pocket pivot, a recent kahuna. So all these stocks remain challenged, and perhaps they're indicative of where the marketplace is going. Now, before I go further, I'm going to do an audible here. Actually, I'll do the audible in a second. And then, I like to look at the Lowry buying and selling pressure, and it's hard for me to be all in on the long side when the selling pressure still is far above the buying pressure. And when you look at the S&P, it rolled over commensurate when these things started to mingle and then start to separate. So let me do my audible right now, and I want to add some slides here. So I'm going to stop this and I'll be right back. Okay, I'm back. And what I really wanted to do was show you what I put together to help me look for periods of time where the market may be at risk and rolling over. For years in Palos Verdes, I would go to the front of the room with a list of 200 stocks or so and work with folks to identify stocks that were the leaders, make sure we're recording, of the market at that time. And sort of the parameters were to find anywhere between 15 and 25 stocks, have them be market leaders, often lower left to upper rights and tight, and then create an index of these leaders and then watch this index every day, and recognizing that when this index rolls over, it might be a fairly good signal that the market itself was about to tank. So on the right, you can see a list of the stocks that I thought represented great leaders now. You have some retail, you've got some technology, you've got some life sciences, you've got an airline, you've got some restaurants, you've got some gold, you've got utilities, not a lot of biotech, which is kind of interesting because they typically, especially with my background, they typically are all over the place on my list. And then I created an index from here, and you could see on the index that we've almost gone into a climax run here. So it'll be very interesting to see if this index will give me an early warning sign of this market turning over. As we always say, know your EPS dates in the news, kind of a lighter weight news. There's still always some employment or claims information. You got some natural gas and crude inventories. You got some prices, export and import prices. Probably all in all a quiet week, although these energy, especially the crude inventories, seem to have a big move on energy, which drives the market. The other thing is, you got Urban Outfitters Monday afternoon. If this is correct, you have a lot of solar stocks, a couple other IBD 50 stocks like LGIH. But for the most part, it looks like a somewhat slower earnings week. Market thought then, I added the yellow or changed things in the yellow. I think we're in a stealthy 3 to 5 week rally, which is taking us right back into an area of predicted resistance. Short term, we're becoming extremely overbought, while at the same time, many of these leading stocks have moved to short-term areas of resistance at downtrending major moving averages, which, from what I learned from Gil Morales, may represent fresh shorting opportunities, but I still have to wait for signals. I predicted 3 scenarios, failing where we were last week and retesting recent lows. Second scenario, moving up to the 200-day SMA and failing. I think that's the trajectory we were on. And third, moving to new highs from here without a retest. Again, it appears we are in scenario 2, but watch out for bull traps. But very bullish week last week. And as I said, a lot of concern about resistance coming, but not necessarily obvious from the charts. Tonight's agenda will be the usual. I'll do a quick market review, do a little top-down analysis, a few comments, and go over the chart of the week. Chart of the week is something we've been doing now for several months. I pick one of my favorite stocks from looking at the market. I give you clear-cut where I'm going to buy it, where I'm going to put my stop, where my target is, how I'm going to manage it, and then the next week we talk about the performance. I do this so you understand my thought process and how I put everything together. I neither warrant these trades, nor will I tell you if I take them or don't take them. It's for educational purposes only, and I hope it helps you learn to trade yourself by hearing me talk out loud my thought process. Last week, I thought it was an easy one. The market was in bullish mode, and I spotted Mosaic, agricultural chemicals. I liked it because it broke above and closed it near the high of the day of the 50-day moving average. It had a mobile breakout from a squeeze. The daily and weekly bongo were green. It had pocket pivots and a positive kahuna, and its OBV was trading above the moving average. What would I not like? That's all my positive buy signs. I looked at it in TradeStation on the weekly. I saw you had a PPS weekly buy signal coming in, OBV moving up, and on the daily, we're in a PPS buy going back here. Great OBV. We just turned positive on the weekly bongo this week, and we're coming out of a squeeze. So I basically gave these parameters. I like to wait till I take out the high of the day before I put my buy stop. I chose my stop based upon the chart and a target for the initial aliquot of 1-to-1. Here's how the trade went. I actually filled on Monday, and then the stock sold off a little bit. It was an inside the bar day for the most part. Didn't do much on Tuesday. On Wednesday, we had a high close doji, and we took off, and you could see the big move on the weekly chart. Notice how OBV is strong. Now, I did one of my favorite trades here. I decided to push it to April, and I call it my chicken shit synthetic or a protected synthetic position. And what I elected to do was to buy an April 26 call, and I bought that for $2.15. I sold an April 26 put for $1.47, and that means I had about a 39-cent, no, that's not right. Let me get this right, a 53, 68, 67.4 cents for that spread. So instead of buying at $2.15 a call, I bought the calls for 67 cents. And then I bought a protective put for 56 cents. So I paid about $1.20 per for this thing times 50, or $6,000 investment. Now, my goal would be, let me go back here, and I've already taken off half the position, by the way, because we ran right up into my target, and my trading rule during these tumultuous times is when I hit my target, I have a stop put in there, I take half my position off, and I raise my stop to break even. So this is what I'm left with. So if my initial investment was $6,000, and I've sold half, that means I've left with an investment of $3,000. Bought 3.1, 3.4 was the last trading day of the week, and that $3,000 investment now has a profitability of $13,325. So I've ran $3,000 to $13,000, and like I said, I've already taken half off the table to ensure that this will be a profitable trade and raise my stops to break even. I looked at the odds on the various trades, and what I don't like about the synthetic long position is I still have an infinite loss. And that's why I buy that protective put, which protects my downside. So my plan this week on Monday will be to spend the 40 cents and close out the 23 and 26 put, book whatever profits I have there, make the tax man happy, and probably let the 26 call run until I see a sell signal. We'll talk about this week's chart of the week soon. So, first thing I like to do is pull up my trade station and go into my market charts. Just take do a quick run through the major indexes. We'll start with the S&P 500 on the cash market. It's a blue. Now, blue tells me that it's a little bit of indecision, and that I can be long or I could be holding, but since it's blue, I could also be shorting, which is the elder impulse indicator. A green paint bar means I should be long or holding, and a red paint bar means I'm allowed to be short or holding. So I've got a blue paint bar on the daily, green on the weekly, blue on the monthly. So all of that could be okay to hold. I'm in both a daily, there is a, promise you somewhere there's an arrow in here. I don't know what I did wrong with this, so it doesn't work. But there is a buy signal here underneath where my arrowhead is. I'm in a weekly buy, a monthly sell, and these green dots are what you see when you have some MACD divergence. You have a lower low here on the MACD, but not, on the price, but not a lower low on the MACD. So that also signifies a reversal potentially coming on the weekly. So this still looks pretty healthy, getting near the top of the auto envelope, which is probably why it went to blue and increases the risk. I look at the Dow futures, or the Dow cash, similar picture, buy signal on the daily, the weekly, with blue and a green getting near the top of the channel. If I look at the NASDAQ, again, blue doji with a daily and a weekly buy, monthly, and a sell signal. So right now we're still in retracements on all of these against a longer time frame downtrend. And then lastly, the Russell 2000, which has been the laggard, is up near its auto envelope, is green, green, and blue with a buy signal on the daily and the weekly. So markets look pretty good and tell me that it's okay for me to be long. Yes, I'm concerned that we're toppy. Yes, I'm concerned that we're going to go into a tougher market time, but I got to trade the market I got. And right now, the market still says to be long. Let's open up HGSI. And we'll start with my warehouse view. And we're going to go to the major market indexes. Major Markets Plus, and we're going to put top-down view. All the WB stuff is courtesy of Ron Brown. He does a great job of helping us learn how to use the program and putting things up there for free. So let's take a look at this first. So I've ranked it by raw combo. This is only price and volume, putting more weight on Friday, some weight on Monday through Friday, and a little bit weight of the last 3 weeks. So you notice that small mid-cap stocks are up at the top, so that tells you that growth stocks have been doing well. So if we look at accumulation distribution, we've got a lot of A's and B's. We've got a lot of bongo dailies and bongo weeklies being green. That's bullish. If we take a look at some of these, look at the S&P 500, which was number 17 out of 23. So I guess you could argue somewhat of a laggard. And you can see, as I showed you before, it's meandering itself up towards that 200-day moving average, which would be a rather obvious place to look for support and a failure. If I look at the Dow, same pattern, everything's green up here, starting to move up towards resistance at that 200-day moving average, and we'll see if it can break through here. My guess is it will struggle as it has in the past. The NASDAQ composite has more room to go, clearly in an uptrend. Everything green, including the bongo weekly. And then the Russell 2000, same, looks just like the NASDAQ. So my impression of the markets is they're all in bullish mode, and they all should be heading up, but several of them, especially the Dow and the spiders, are getting close to downsloping resistance. If I take a look at the dollar using UUP, I can see the dollar failed at the 200-day moving average on Friday, and I would say this is a very bearish looking chart with the bongos going negative, but there's so many world politics and world financial issues that are outside our control. The dollar may continue to be whipsawed up and down, again, outside of our control, and may or may not be as relevant. If I look at the VIX, pulling into support and had a green candle low, does that potentially mean that it's at a reversal point? We'll watch that, because it's hard to be making money long if the VIX is rapidly rising. So the dollar was weak, so what does that mean about gold and silver? It means that gold, it looks like a sell signal to me. A red candle high is marked here, although everything's green. Not quite a shooting star, but a much bigger wick above, meaning the stock opened up here, traded up here under our supervision. Excuse me, I don't know what I meant. I was falling asleep. Traded up here on bullish pressure, and then it closed down here. Excuse that last comment. I think I was dozing off. That's what happens when I travel. Bottom line is that that's a bearish-looking candle. Traded up, couldn't hold the new highs, failed new highs, closed down on the day, then thus a red candle high. But gold has had a huge move. In fact, if we want to measure that move, go from this island reversal day up to the high here. We've had 21% in 52 trading days. That's a pretty big move on gold. That's gold. What does silver look like? Silver had a pretty good week last week. In fact, it even had a PSA reversal. But like gold, it had a failed new high, or not new high, but failed to keep this advance and pulled back during the day, although it still traded up for the day in a green candle, and all my indicators up here are positive. So gold and silver may have some more room to go. Interestingly, seasonality for the contras to gold, dust, J-dust, actually look very strong on seasonality charts, which makes you wonder how much gold and silver, which are not seasonally strong right now, have left in the tank. The next thing I like to look at is go down to 07, the industry groups. As you can see, we have 171. And if I look at short-term momentum, I could see that I've got 93 of the 171 are moving up. If I look through exploration, oil, gas, banks, oils, metals, internet, telecom, e-commerce, autos. So lots of energy and banks. If I look at 2-day force down, I see casinos, insurance, wealth management, managed care, and computer hardware. So, all right, let's take a look and see if there's any nice looking charts that we can look at. Change the index group. These are all, I won't say junk off the bottom, but these are bounces off the bottom on energy stocks. Chesapeake, and some of these had just major moves last week, 1, 2, 3, 4, 5. From top to bottom last week on Chesapeake, crazy story, suicide of the boss who was going under indictment, the old boss. Before it pulled back some, that can't be that, I guess it is. Chesapeake had a move last week of 127% in 4 trading days. Now, if you had just bought it on that first day, you had a great return. Unfortunately, if you've been holding, waiting for it to recover, you may have come down from before last week's run. Chesapeake was down 95% in 85 trading days. I highly doubt you were holding on to it this long. So Chesapeake with a big move, that's not days, that's 85 weeks. So a couple of years. So big move off the bottom, Chesapeake. Marathon, interestingly, had an IPO last week on this day, and has had a big move since then. I think that's bullish. Bongo went to green. I do have a position here that I'm holding. It's one of my bottom fishing energy stocks. Whiting, another cheap stock with a move, big move this week. You have to know what these are. These are not growth stocks. These are not expected big moves. I mean, these are not big moves based upon the fundamentals. These are a lot of emotional. These are very oversold, and they're moving on the price of oil. Conoco's a bigger company. The fundamentals are horrible. It does pay a dividend. Did break above the 50-day moving average. That looks interesting. Southwest Energy broke above the 50. Another of these bottom fishing stocks. SM Energy, a big move over the last couple of weeks. 124% in 7 trading days. So some of these energy stocks have had a big move, but they're all really bottom fishing stocks of a group that's been clobbered. Oil and gas services. Take a look at Seadrill. 121% movement on Friday, 215 on the week. Now that's the good news. This is a stock that used to pay a huge dividend. It's gone to 0. Interestingly, now the stock starts to go up. It was a $45 stock paying a 10 or 15% dividend before this market correction. So again, if you were smart enough to have bought it earlier in the week, you had a huge return. It's hard for me to chase this. It does make money, but there isn't much growth. Look at where the PE, even after this move on Seadrill, on a stock that makes money, that's pathetic. Transocean rig, similar story. Big move off the bottom, 2.4% dividend. Makes money. So you might be able to find some gems in beaten up oil and services. Diversified banks. I think with the interest rates popping, that's good for banks. Here is a ITUB. I think this is a foreign bank. I'm pretty certain of that. I don't know if it's Italian, but let's look at Bank of America, which had a pretty big move off the bottom, coming up to resistance, and it turned back from that 50-day moving average on Friday. And it's still going to be some work, I think, for Bank of America to get over that. Wells Fargo looks a little bit healthier. It actually got above the 50. It had a doji here. Everything turned green up here. This might be a better stock to buy this week. It pays a 3% dividend than Bank of America. Citigroup sitting on the 50, and JP Morgan also broke above the 50. Going down to group number 4, integrated oils. Brazil had a great week. Petrobras helped. And again, you could see a big move. 1, 2, 3, 4, 5. So if we go Friday to Friday, close to close, Petrobras had a 56% move in 5 days. Junk off the bottom, still a cheap stock. Would have been great had you been holding it a little bit late to probably chase. Chevron getting under resistance. Why do I respect the 200-day moving average so much? Chevron broke its 200-day moving average back in 2014. It sort of failed here. It didn't get all the way up. It failed here. It failed here. It failed here. It failed here. Whoops. That's where we are today. So it had multiple failures. Why are we so arrogant to believe that it's not going to fail here? I think until proven otherwise, I'm going to be looking for Chevron to fail here. BP, beaten up stock. So all of these were short-term moves because of the oil prices moving up. Not necessarily great buy points. Base metals. A couple weeks ago, I think I pointed out Freeport-McMoRan. I certainly pointed out Techminco as my lottery pick. FCX continues to do well. Sold off late in the day on Friday. Tighten your stops on this one. Be happy with the return you got. It may have some resistance getting over that 200-day moving average. I didn't say sell it all. I said make sure you got good stops. Tech Resources, here's my lottery pick. It broke out above the 200-day moving average. Did have a big wick on top as it sold off late on Friday. But what a bull move since we talked about this. Here's a small dividend. And then Alcoa, looks like it's got a doji right on the 200-day moving average. So these things look like they're running into resistance and may slow down this week. Precious metal mining, no surprise with gold having a good week. There's several gold stocks here. Here's Gold Corp. Now, is that a stock you want to buy? Do you believe that this is going higher? I don't. It's above that 17-day moving average. But if that doesn't qualify for as a shooting star, I don't know what ever will. I'll be looking for the stock to gap down this week and give us an evening star formation or at least a low close doji. But I think that this is coming down to at least retest the 200-day moving average. Silver Wheaton, similar pattern. Rand Gold, great move, but still similar pattern. These look like they're getting overbought. Seabridge Gold, same pattern. So would you rather be buying next week Nugget, which looks like it's giving us a shooting star here, or would you rather be buying Dust? This was one of the things we talked about at the meeting, where at some point we're going to switch from being long gold to being short. I'm not saying that we're there yet, but I'll be watching it. Internet media, Yahoo in talks to sell off some of their legacy assets. Coming right into, drum roll please, resistance at the 200-day moving average. Did have all green here, pocket pivots, OBV looks strong. Twitter broke above the 50-day moving average with pocket pivots. Everything's green, had a red candle high. We'll see if it's stalling out here or not. LinkedIn, this has been a up and down stock. Sold off on earnings. I wouldn't be playing this right now, not making money. And then YY, I believe on earnings on Friday or Thursday, had a big move Friday with kahunas, everything turning green. That looks pretty good. But it's right up against resistance as well at the 50 and the 200. Are you noticing a story here? Beaten down stocks, moving back up, running into resistance. One of the leaders over time has been teleconferencing and communications. This is AT&T, pretty much near a high, pays a 5% dividend, has a doji there. I would rather have been in this back in early January. I did buy several weeks ago CenturyLink that's had a nice up move as well, pays a 6.8% dividend. And here's Straight Path Communications, pull back to the 17, had a nice move on Friday. If I get a little bit incoherent, for whatever reason, I'm tired. Maybe it's because of this back and forth, coast to coast. I haven't been drinking, I only had one glass of wine. E-commerce is group number 9. We'll just take a look at Netflix. And Netflix looks to me very viable. It's broke out above its 50-day moving average on Friday, had a pocket pivot, still in a weekly bongo red that I'll look to change soon. I also look to see if I can get above the 200-day moving average. I'm long this. But of course, I had sold some calls way out of the money, and I think they're at 110. We'll see if we end up getting there in the next 2 weeks. Wouldn't surprise me the way it's been moving, in which case I'll either buy back the calls or let my Netflix go away. And then automobile index, had my first ride today with in Dev's Tesla. What a great car. You know, it's beaten up stock. I did short it this week and got my lunch handed to me. It was funny, I talked about shorting today, and you know, I learned from Gil to take some probes at shorting, and I thought this was a setup of all setups right here. I have a stock that's been in a downtrend, that's pulled back or retraced up into moving average support, had a doji, had a low close doji the following day, which to me is a perfect short signal, although OBV was still strong. And I bought some puts, and immediately the stock reversed the next day and traded up and broke above the 50. I still think those puts are going to work because I think this market's going to have a pause or roll over. But right now I'm pretty much underwater on my puts. All right, so now I've gone through the top 10 groups. I've given you a sense of what I think the market is doing. I am concerned that the market is coming up to resistance, but I don't see any clear-cut I need to sell signals yet. So I went through and I built buy watches for both shorts and the longs, and I'm tired today, so I'm just going to look at a couple of them. These were some of my favorite picks to the long side. They've got fleas. None of them are necessarily perfect. Netflix we just looked at. Builders First Source, consumer discretionary retail. It doesn't show any earnings. That probably is an error. So I don't know what the earnings are. You could see the earnings per share growth the last couple of quarters was very strong. Demand is pretty good. Anytime I see something above 2 or 2.5, that tells me there's good demand. It does trade 1.6 million shares a day, and it did break above the 50 moving average. It's got about a 20% gain to get it into the 200. Big volume on Friday. I thought this one was interesting. Here's MDU Research Group, a materials construction stock. Earnings per share growth is rather tepid, although it's probably enough to support a PE of 20. But what caught my attention on MDU Resources was everything was green up here. It broke above the 200. The 8-day and the 17-day have turned up. The 200 has turned up. We've had a bunch of market pivots and an upgoing OBV. I like MDU Resources. BGC Partners. A lot of interest in this one, breaking above, in a squeeze, breaking above the 200 and the 50. Everything turning green, OBV going up. Arctic Cat, they do more than snowmobiles, leisure products. Earnings are not great, but nice steady uptrend here, but it is below the 200-day moving average. Those were some of my favorite filtered longs. On the longs that did not filter, by filtering it didn't pass the mustard on my HGSI work. If you don't mind buying tobacco stocks, this is a pretty steady eddy. Altria pays a dividend of 3.6%. CenterPoint Energy, broke above the 200-day moving average, pocket pivots, kahunas, mobile breakout from a squeeze. Notable because it pays a 5.3% dividend. We've seen a lot of these. Let's take a look at BGC Partners. BGC Partners Institutional Brokerage. Like several of the ones I've liked, it's broken above the 250 moving averages. One of the reasons why I like this pattern is because you notice, I don't want that one, hold on a second. You notice how many lines are up in this space. Moving averages. There's not a lot of overhead supply or resistance. 70 cents gets you to old highs. There's not a lot of resistance on Builder First Source, excuse me, on BGCP to come out and touch the new highs. We'll come back to this. On the short side, I won't say that I found the greatest setups. Casey General Stores has sold off a lot. I think it can sell off even more. If I go to a weekly chart, pull back to the 50 weekly as it's done several times. I thought this was potentially setting up for another short as it pulls into the 200-day moving average. All right, so we've done our top-down view. I've looked at a couple of industry groups that were interesting. I showed you a couple of my buy list stocks. Because I am tired, I'm going to probably call it a night. So let's go back into my PowerPoint. And let's go into the chart of the week for this week, which is the week of March 6th, 2015. BGCP, which we just looked like, is my stock of the week. Just to review, it's a new weekly bongo green, except for the yellow on the accumulation distribution. Looks great here, coming out of squeeze and a mobile breakout. Recent kahunas, group strength, moving up off the bottom. I thought this looked like a relatively low-risk buy, being that it's broken above these moving averages. Again, I see a lot of open spaces above it, and I see a lot of support underneath. My trading plan was I looked at it under my trade station. I had a high close doji on the weekly with a new PPS weekly buy, a recent PPS daily buy. Look at how OBVs are far leading price. Here's the daily and the weekly bongos green. We're coming out of a squeeze on both the daily and the weekly. So I see a lot of opportunity here. This white bar is my buy point at 920. My target one is 980, and my stop placement is at 860. Assume risk per trade of $2,000. Risk is 60 cents per share, about 6.5%. Therefore, I can purchase 3,300 shares. If you find this stuff interesting and you want to learn more, please contact me. We're always adding members to our PUG user group. I am an unpaid volunteer. I do not charge for my services, but we do have to buy the indicators from John. The indicators are about $3,500 all in. If enough people show interest, I can probably get us a discount on that, or at least ask. But if you own the indicators, then hopefully you'll buy HGSI, and you'll get to participate a lot in our user group, which includes John Person, who does some great education. So on that note, I say see you later. A lot of questions about when my next Florida meeting is. I'm tinkering with the summertime when rates are low, but to be honest, I have not made a decision yet because of my travel commitments. So I'll just summarize up today with one slide. We'll go back here, which is a lot to love here on the S&P. Bongos in force are green. Pocket pivots and kahunas. We are way off the highs, so we certainly can go higher, but I'm concerned about the imminent overhead resistance in that 200-day moving average. In Nirvana, we'll break above that and probably trade up to my trend line here. So on that note, be careful, watch for signals to the downside, but you got to play the market you got, and the market you got right now is a market that is long. Good night, everybody, and we'll talk to you next week.